The ongoing boom in online healthcare and consultations has led to merger and acquisition activity in the telehealth services space. This is especially true as the largest US telemedicine provider, Teladoc Health Inc, ticker symbol TDOC, has agreed to buy chronic care provider Livongo Health Inc for $18.5 billion in stock and cash deal. The transaction will create a company that can serve a wide spectrum of health needs using virtual care. This is not surprising as virtual healthcare has been on a spike lately due to the healthcare challenges in 2020, which has kept patients from visiting their doctors. The latest study shows that about 46% of Americans now use telehealth to replace canceled visits, up from just 11% in 2019. Following the news, shares of Livongo declined 11.4% to close the day and crushed its average volume as nearly 31.6 million shares moved hands, compared with only 4.4 million on average. Meanwhile, shares of Teladoc were down 18.7%. That said, both shares have recovered a little bit and were both up in the stock market trading today. I'd like to remind investors that both Teladoc and Livongo have been flying higher this year, reaching their all-time highs on soaring demands for virtual healthcare. In fact, Livongo's share price is nearly 6 times higher than it was at the start of 2020, and Teladoc has tripled in that period. According to Yahoo Finance, under the terms of the deal, Teladoc Health will pay the total deal price of $158.99 per share for each Livongo share. This represents a 10% premium over Livongo's stock record closing price of $144.53 as of August 5th, or almost 18% premium over today's closing price of $134.35. It also represents a valuation of nearly 35 times of fiscal 2021 revenue for Livongo. Upon completion of the merger, Teladoc shareholders will own approximately 58% and Livongo shareholders will own the remaining 42% of the combined company. Teladoc focuses on providing virtual visits to patients in a variety of specialties and modes. Meanwhile, Livongo, which got its start in diabetes care, has created health management programs for individuals with chronic conditions. As a result, the merger of the two companies will create the global leader in consumer-centered virtual care industry. It will put Teladoc Health at the forefront of the next generation of healthcare, where demand for virtual care is surging. The combined company is expected to have pro forma revenue of approximately $1.3 billion for 2020, representing year-over-year pro forma growth of 85%. The pro forma adjusted EBITDA is expected to be more than $120 million for 2020. Looking at the latest quarterly earnings for these two companies, Livongo reported quarterly revenue of $91.9 million, representing 124.8% year-on-year growth. The company reported earnings per share of 11 cents. As for Teladoc, in its latest quarterly earnings released on July 29, 2020, the company reported a negative 34 cents earnings per share for the quarter, missing analysts' consensus estimate of negative 23 cents. The company earned $241.03 million during the quarter, compared to analysts' expectation of $220.49 million for revenue. That said, Teladoc's revenue was up 85% compared to the same quarter last year. A financial analysis of these companies show that both Teladoc and Livongo are loss-making companies at this time. But both companies show a very positive current ratio, which indicates both of them have enough resources to meet their short-term obligations. If you're not familiar, the current ratio compares a firm's current assets to its current liabilities. Any number over 1 for current ratio is a positive sign. As an investor, if you're looking for a less direct approach to owning the shares of these two companies, you may consider buying shares of some quality healthcare exchange-traded funds. Here are a number of healthcare ETFs that you may consider. Franklin Genomic Advancements ETF, ticker symbol HELX. This ETF provides access to companies benefiting from or facilitating the use of new research, including DNA sequencing, gene editing, and personalized medicine. It holds 56 stocks in its basket, with Livongo and Teladoc making up for 5.7% and 3% respectively. It has accumulated $3.5 million in its assets base since its launch in late February 2020 and has a net expense ratio of 0.5%. The second healthcare ETF to review is Invesco DWA Healthcare Momentum with ticker symbol PTH, which follows the DWA Healthcare Technical Leaders Index and holds a basket of 51 US companies. Teladoc and Livongo make up for around 5% of their assets. This ETF has an expense ratio of 0.6%. Lastly, the third healthcare ETF to review is iShares US Healthcare Providers, ticker symbol IHF. This ETF follows the Dow Jones US Select Healthcare Providers Index with exposure to companies that provide health insurance, diagnostics, and specialized treatment. In total, the fund holds 48 securities in its basket. Teladoc and Livongo account for 4.7% and 0.5% share, respectively. This ETF has an expense ratio of 0.42% and has a medium risk outlook. Do you own shares of Teladoc stock or Livongo stock? What do you think about these two companies and the Teladoc and Livongo merger? Let me know in the comment section down below. There you have it, folks. I hope you found this video of value. If you did, please be sure to give it a thumbs up and share it with someone who might benefit from it as well. And if you have not subscribed to Momentum channel, please be sure to do so. Here on Momentum channel, we post weekly videos about stock market investing and finances. Hope to see you next time.